Okay, so you want to own a hotel. You picture the lobby with your name quietly stitched into the carpet, guests checking in under a chandelier you picked out, a rooftop bar with your signature drink on the menu, and a bank account that fills up every time someone wants a bed for the night. Passive income, real estate appreciation, a tangible thing you can walk into and touch. Sounds simple. It is not simple. By the end of this, you're going to understand exactly how hotel ownership actually works, what it really costs, where the money actually comes from, and whether it's worth the headache. Let's start with the number nobody wants to say out loud first: entry cost. A small, tired roadside motel with 20 to 40 rooms in a secondary market can run you anywhere from $1 million to $4 million. A branded, mid-scale hotel, think a recognizable name attached to a highway exit, is usually $6 million to $20 million depending on room count and condition. A full-service hotel in a real city, the kind with a restaurant, event space, and a name people actually recognize, starts around $20 million and climbs into the hundreds of millions for anything flagship. And here's the trap that catches new buyers off guard: the purchase price is never the real number. Lenders typically want 25 to 40% down in cash, and on top of that you need a PIP, a property improvement plan, which is the brand basically telling you, in writing, everything you're required to renovate before they'll let their name stay on the building. That PIP can easily run 10 to 20% of the purchase price, due within 12 to 24 months, whether you budgeted for it or not. Buy cheap, and you're usually buying somebody else's deferred maintenance. So how does a hotel actually make money? It's not just rent times rooms. There are layers. Layer 1 is room revenue, obviously, but the metric that actually matters isn't the price per night, it's RevPAR, revenue per available room, which blends your occupancy rate with your average rate. Here's where it gets interesting. A hotel running 80% occupancy at $120 a night can out-earn one running 50% occupancy at $180 a night. Owners obsess over rate when they should be obsessing over the blend. Layer 2 is food and beverage. A restaurant or bar inside a hotel usually operates at thin margins on its own, 5 to 10%, but it exists to keep guests spending inside the building instead of walking across the street. It's a loss leader that protects the room revenue. Layer 3 is event and meeting space, and this is the counterintuitive one. A single well-booked ballroom can generate more profit per square foot than 15 guest rooms combined, because you're not paying for nightly housekeeping, laundry, or turnover. You're renting empty air for 6 hours and charging for catering on top. Layer 4 is ancillary revenue: parking, resort fees, minibar, spa, early check-in charges. Individually small, but on a 200-room property these junk fees can add up to 7 figures a year, and it's almost pure margin. Layer 5, and this is the one hidden in plain sight: the brand itself sometimes makes more than the owner does before a single guest checks in, through franchise fees, loyalty point reimbursements, and reservation system charges. Read that again. The name on the building often gets paid regardless of whether you turn a profit. Now, the hidden costs. First, labor. A full-service hotel needs front desk staff, housekeeping, maintenance, food and beverage staff, and management. Payroll typically eats 30 to 40% of total revenue, and it's the first thing to spiral if you're short-staffed and paying overtime. Second, the reserve for replacement. Most franchise agreements legally require you to set aside 4 to 5% of revenue every single year just for future renovations, whether you want to or not. Third, seasonality and rate volatility. A single bad quarter, a canceled conference, a new competitor opening 2 blocks away, can crater occupancy fast. And here's the domino effect. Low occupancy doesn't just mean less revenue, it means you fall behind on the reserve fund, which means your next PIP renovation gets financed with debt instead of cash, which increases your monthly obligations, which pressures you to cut staff, which hurts guest reviews, which hurts your ranking on booking platforms, which lowers occupancy further. One soft season can start a spiral that takes years to unwind. Consider a composite case, built from patterns seen across the industry. A couple buys a 60-room branded hotel for $9 million, right before a recession hits their region's tourism. occupancy drops from a projected 70% to under 40%. They defer the required PIP renovation to save cash, the brand threatens termination of the franchise agreement, and within 18 months they're forced to sell at a loss just to get out from under the debt. The takeaway: in hotels, the building doesn't fail, the timing and the reserve fund do. Let's talk numbers in a good year versus a bad year, using that same 60-room hotel as an example. In a good year, at 70% occupancy and $140 average nightly rate, that hotel might generate around $2.1 million in room revenue alone, and after operating costs, debt service, and reserves, an owner could realistically net $250,000 to $400,000. In a bad year, say occupancy drops to 40% because of a new competitor or a downturn, revenue can fall to $1.2 million, and after fixed costs like debt, insurance, and staffing barely move, that same owner could be underwater by $100,000 to $200,000. The gap between a good year and a bad year in hotels isn't a rounding error. It's often the difference between a comfortable profit and a call to your lender. So why do sophisticated investors keep buying hotels anyway, knowing all this? A few real reasons. Depreciation. Commercial real estate, and hotels especially, offer aggressive depreciation schedules that can meaningfully offset taxable income elsewhere in an investor's portfolio. Appreciation. Land under a well-located hotel tends to compound in value over decades, separate from whatever the operating business does year to year. Refinancing flexibility. Once a hotel is stabilized and cash flowing, owners can often pull equity back out through refinancing without ever selling the asset. And status and control. A hotel is a tangible, visitable asset that stock portfolios can't offer, which matters more to certain investors than the spreadsheet suggests it should. Here's the thing nobody tells you: a lot of hotel owners aren't really in the hospitality business. They're in the real estate and tax strategy business, and the hotel just happens to be the vehicle. So, do you actually want to own a hotel? You're not really buying a building. You're buying a business that never closes, that depreciates its own product every single night a room goes unsold, and that answers to a brand you don't control as much as a market you can't predict. For the right buyer, with enough reserve capital and enough patience for the bad years, it can be one of the most durable assets you'll ever hold. For everyone else chasing the lobby chandelier fantasy, it's a 24-hour-a-day business wearing a real estate costume, and the difference between those two mindsets is usually the difference between owning a hotel and being owned by one.